Good afternoon, traders. In this video, I'm just going to be going over how you could have played the open, specifically the open. I'm not going to be going over the whole day. I guess I can make a separate video about that. But I'm just going to make this one kind of short on, I got a question on how someone should have played the open. So I'm just going to go over, because I thought the open was pretty easy today. So I'll just go over how you could have played the open. So right off the bat, we get a, first off, before we start anything, we have to acknowledge that we are in a range, right? We're in a tight range between 160 and 400. So before we even get into the day, we kind of have to make a plan. Know that we're basically just stuck between, on the bigger time frame, we're stuck between 150, 160, and 400. And if you zoom in a little bit more, we're kind of stuck in between around 250 and 350. So somewhere around this range right here. So first things first. We can go ahead and chart the, I just did this for someone right now, but we can go ahead and chart the overnight high, or last day's high, and so you can see how we're stuck in a range. So you just want to play the edges, you want to stay at the middle. If there's like a lower high or lower low that you could short, go ahead. So first things first, well, the 427 here is from a different level, as you can see here, but we're gonna plot the last day high, which is right here, and we also have some type of level here at 380, and then we have another level here at like 407. So let's also put that one. Okay, now let's zoom into the 1 minute, because you're trading the open, you can't be looking at the 10-minute. Okay, so we know we have this 406 level, which it rejects right there, that I just charted right in front of you, and we know we have this 375 of last night. Overnight doesn't really do anything. It kind of pumps up into the open, but it doesn't really do anything. And it rejects right away. It's totally fine. You don't gotta take a trade off the open. Sometimes the open is very volatile, as you can see. It moved here from 400 to literally 340 in 4 or 5 minutes. So it's a 60-point move. If you went long here, you would have gotten absolutely screwed. You would have probably sold somewhere here, and would have reversed, would have messed up your whole day. Okay. So let's say you don't trade the open, you missed that one. Now you have a pivot that you could play off of. Now you have this 401 level, 402 level, 400s level that you could trade off of. And you have a pivot at 405 from the other day. And it rejected here. So all you need to do is you could short somewhere here with a stop at 405, or a stop like a little bit above like 410, 411, 415, doesn't matter. A stop a little bit above, so you're risking 10, 15 points for the possibility that it goes at least 20 points lower. If this works, it's not like it's going to dip 5 points, right? For the chance that the trade actually works, this is dipping at least 20 points, 30 points, and you're risking 10 points for it. And this is a valid trade setup, right? You're shorting a rejection and a previous pivot. So there's a decent probability for this to work. And you're risking 10 for 20, 30. So we're looking at multiple risk returns here already. And there's a good probability. Now let's say you missed this short right here. Remember, you did not touch the open, and you missed that short. And it comes down here, and you're like, it looks way too aggressive. I don't want a short or long. It bounces up and down. It's ranging. What's it called? So it's just ranging, right? So we kind of established this kind of support area. So we'll draw a little box somewhere here. All right. So just only based off this, as if we didn't know this existed. So you could kind of long this area with a stop somewhere around like 320 or something, or 325. So you're risking 10 points for the chance it bounces back to 355. So you're risking 10, 15 for 20, 30 points. Once again, double or triple the risk, and there's a decent probability it works, right? You're just buying the dip of a range, and if you don't know this would happen, you could have probably expected something like this to happen, something back to the highs. If that was your bias, right? Now let's say you were leaning short, and you're looking at this as a lower high. So you look at somewhere like this, and you're like, oh, well, I see some sort of pivot here, some pre-market here. We know the 375 level is right here. Like, you got to understand, the market doesn't really work by exact technical levels like 375 and 374. It's kind of an area. It's kind of a zone. So we can kind of just go like this. All right, we know, like this box right here, we have this line. You can kind of see here, right? And at first here it pops here, it goes back down. Let's say you went long here, right? This is your time to short. like somewhere around this box, somewhere around this area, somewhere in here, with a stop either above 75 or above 390. So this might be a bigger stop, but because you're trading lower, but your reward is significantly stronger. It's significantly more. You're aiming to get at least 30 points, which is 1 to 1 already. But if it breaks this range, you're looking at much more. If you check this out, you're looking at least 310, 315, at least somewhere around this area. And when you're shorting 3.6, that's a 50, 60 point move right there. And your risk was what, 20, 30 points? So it's double. Think about it as if you're risking 10 points to make 20, just on double or triple the size. It's the same exact thing. You're just on essentially more size. Like risking 1 point to make 2 is the same thing as risking 10 to make 20. You're just 10 times heavier in one position than the other. One position you'll make $1, one position you'll make 10, you know, or lose, whatever. But like the ratio is still the same. So you could have bought these with a stop a little bit under, or the ideal short, obviously. Well, this is in hindsight, but because you were short biased, whoever asked me this question, you short somewhere here with a stop either at 75 or ideally I would have put a stop above 90, just because I don't want to get stopped out on a pop. I want to get stopped out when I'm wrong. So I'm fine with taking a bigger stop as long as it gives me more room to breathe. And let's say you also miss both these shorts, you can take a short when it breaks this level with like a very tight stop, like a stop like right here, like 6, 7, 10 points, you know, very, very, very small, for the chance it breaks. And the moment it breaks, you scale 1, 2, whatever size you're in, and you let the rest play out. You have a trailing or whatever, and you know, it literally just keeps on going. Like you would have been very well off. But yeah, like there's many different ways you could have played. You could have short right here. You don't trade the open. You could have shorted right here. You could have bought this zone right here, with a stop a little bit under and sell at these pops. And you could have shorted both these pops with a stop a little bit above. And then the last trade you could have done is short this range, short the breakdown of this range. Or you could have tried to play the breakout up. So let's say this went up. You would have bought somewhere over 370, 375 for a move back to 405 and 427 and, you know, a trend day or whatever, you know. So you're just playing a range break instead of trying to like catch a top or a bottom. And yeah, that's how you could have played the open. I hope that helps.